All right, and we're off. Welcome to the next edition of Lumina Non-Consensus Investing. I'm thrilled to be joined by Meb Faber. So Meb is someone I've tracked for at least 10 years. I think it might have been your alpha clone paper, and you've published quite a bit of research. We'll get into that. And you've also launched a variety of ETFs. And Meb is also a non-consensus thinker. He's looking at names beyond Mag 7 and different ways to express that through like shareholder yield and other kinds of factors. So we're going to get into a bunch of topics, including around like, do hedge funds add value? Does alpha cloning work? Market trends, Mag 7 versus the 493. Has passive indexing broke markets? I know, Meb, you've been interviewing Michael Green and some others around this topic too. I want to get your take. Is value investing dead? And which ETFs you're excited about? I know the ETFs you track, ETFs you're launching, and also rules that have made you a better investor that either you developed yourself or you learn from others. And as we go along, I'd encourage the audience to dig in and ask questions. So, Meb, what's the best way to introduce yourself?
That's a lot. I mean, I think you did a good job, although I think if investors had just invested in the Mag 7, they would have done much better than anything I could possibly say today. So non-consensus doesn't mean right. So maybe, NVIDIA is creeping right back up to all-time highs again. I mean, we have an old tweet that's kind of fun that looks at, it was like, what was the first stock to hit the various milestones? It was like 10 million, 100 million, billion, 10 billion, 100 billion, trillion. So we'll see who gets to be first 10 trillion. I don't know what people, but
I'll bet on NVIDIA on that one.
They're halfway there. It's not going to take that much more, but it'll be fun to watch no matter what.
Right. And I think one of your first papers, or at least the paper I ran across was, and this might have been 10 years ago or so. That's back when like weblogs and publishing an SSRI was like a thing. Now it's all short form Twitter content, right? But you had a very interesting thesis around alpha cloning. Do you want to define what alpha cloning is? And of course, it's timely. We just had a bunch of 13Fs drop, and we saw movements off those drops. What's your take on like hedge funds add value? Does alpha cloning work?
Well, so, if you think back to the 2000 decade, the aughts, that was really the golden age for a lot of traditional hedge funds. And one of the reasons why is you had the market cap weighted index, so the S&P, reach its highest valuation ever in the late 90s. So 1999, it hit a long-term P ratio of about 45. And so for perspective, historically, the average is around 18, low inflationary times, it's low 20s. Today, it's all the way back up to around 35. So expensive, but not the real bubble territory we had back then. And so almost anything outperformed for the next decade. Gold, real estate, small caps, value investing. You guys remember that? So hedge funds, a lot of the traditional strategies, if you invested in anything other than the S&P, you look brilliant for about a decade. Money flowed in. A lot of the endowments, which were heavy into these sort of alternative investors. But, I had a thesis where I said, traditional hedge funds, it's not an asset class, right? It's more of a structure and an approach and more of a compensation structure than anything. And traditionally, hedge funds charge 2% management fees and 20% performance, which is an enormous amount. And so I got a bug in my brain, and I got to thinking, and I said, and Warren Buffett's not a hedge fund, but he runs a very large equity portfolio, but it's mixed in with things at Berkshire. And I was like, what if you just bought what Buffett bought? And we have a fun old tweet where we ask people, we say, do you think you're a better stock picker than Buffett? And everyone's like, no. And then the follow-on tweet is, well, do you invest in Berkshire or buy his stock picks in the 13Fs? And everyone is also like, no. And there's a disconnect there, right? Everyone knows he's a better stock picker, but doesn't invest in his stock picks. That's an odd disconnect. Anyway, so I said, well, could you just track Buffett through his publicly disclosed filings? And so for listeners who don't know what a 13F is, there's certain rules and they change over the years. But if you're a large institutional investor, you have to disclose your portfolio once a quarter, but it's 45 days delayed. So everyone just assumes that this delay, the information is going to be stale. But a lot of the great stock pickers, Seth Klarman, Warren Buffett, on and on, they don't trade that much. And then even then, if you ask Buffett, he's like, timing is not necessarily my alpha or my strong point. And so there's been cases where Buffett buys a stock and then it continues to go down, right? So if you look at, so we did a study on this, and this book's free on our website, as is most of our books. It was called Invest with the House, but we profiled a lot of these managers, famous value investors, and found that, not surprisingly, you could approximate their fund returns. But the big difference is you're not paying 2 and 20 for most of these, right? Buffett, again, different animal, but a lot of these managers, you don't have the lockups, you don't have the minimums. Hey, there's the book. Yeah, again, don't buy it on Amazon. Go to our website; it's free. I got into a fight with Jeff Bezos about this a long time ago. So all my books, most all of them are free that I can control. So anyway, it's a really fun theory. It's a great. We wrote the book and say, hey, it's like an idea farm. You don't have to directly copy all the holdings. There's some nuances in there, like the macro managers. People are always talking in the media. Here's what Dalio and Bridgewater are doing. And you're like, well, hey, hold on. You don't necessarily want to be following some of these macro managers because some of the derivatives don't show up, some of the options and shorts and all these other things. Yeah, look at all those free books. We're doing a update to Shareholder Yield this summer, so hopefully out by year end. Stay tuned. Anyway, I think it's a strategy with a lot of merit. If you're a person that's either looking for stock ideas, say, and my favorites are not the like hedge fund hotel names where you're like, oh my God, every single fund owns this stock. I like the ones where I look through the holdings like, oh, I've actually never even heard of this position. So anyway, it's a fun idea, fun strategy, and worth digging into. The problem is for most investors, they don't know who most of the hedge fund investors are, right? They've probably heard of Buffett, maybe heard of Seth Klarman. Now they've heard about Ackman and Icahn just because they're in the news all the time. But the others, David Tepper, they know him as the Panthers owner, not the fund manager.
And popularity isn't performance, right? Ackman has a top position in Chipotle Mexican Grill, and as of 1 or 2 months ago, he was up 6%, which is substantially lagging the indices. So. I agree with your point.
Second part of what you alluded to is the decade after the GFC has been a lot harder because the market cap S&P has done 15% a year. And so if you just invest in the index and the index is just creaming everything else in the world, we did a paper recently this year called The Bear Market and Diversification, which I'm happy to get into later. But this basically is like, look, if you invested in anything other than the S&P, or particularly these concentrated big names, you probably got steamrolled by the index. Which, hey, look, that's nothing to be ashamed of, because 15% a year is astonishing. But these type of returns on a 10-year basis have really only happened about 4 times in history, and traditionally these periods are famous and they have names, and so whatever we end up calling this COVID meme stock era, in retrospect, we'll probably look back and be like, man, those were the good times. We're telling our grandkids about. We're like, you weren't around for the COVID meme stock. We did 15% a year in the stock market. Can you believe that?
Right. Right. We had the roaring 20s, we had the dot-com 90s, we had the 2010s, and
the nifty 50, which was in the 60s. Yeah.
None of them really ended well.
Well, that's the thing, is like, you never know how long they're going to last.
Right.
And then you also never know when it's going to end and how it's going to end. And so, after the 1920s, you had the Great Depression, which was obviously a giant crash, right? When you think of crash, that is the definition. Stocks went down 80+%. When you think of the Nifty 50 period, that ended in the inflationary 70s, right? So you had a decade of really hard markets, bonds and interest rates went in well into the teens, really painful period for really any investment asset. The .com feels like more of I think a closer analogy to today, which is the market cap index had a monster run of performance, where it ends up being that the concentrated names get to be the most expensive. Again, I don't think it's as nutty as 99. There was a period in 2021 that it felt like it was, in its own way, it was nuttier.
It became a bit close, but we haven't approached 99.com levels.
Yeah. but you never know. So after 2022, I was like, okay, sanity's returning. We're having a cleansing moment, and then we've had a bit of this AI bounce. My guess, and this is kind of coffee happy hour talk, is that within the fullness of time, we'll look back and mark 2021 as the inflection point. But I say that with humility, and also who the heck knows?
Right. I'm showing on the screen here. You can see the data of the S&P 500 forward PE ratio and the median forward PE ratio from the .com era to where we are today. So things were heady back during that period. Now, this isn't trailing PE ratio, which of course would have shown that the .com era was far more speculative from a valuation perspective. So really, the thesis today, right? If you look at the earnings growth, the thesis today is that, well, hey, look, these valuations are justified because of future earnings growth. And if you look at things on a PEG ratio basis, which takes the PE ratio divided by the earnings growth, then you can argue that we're undervalued. So the whole story turns around whether or not we will deliver earnings. And certainly in the last quarter, we have, right? Markets have delivered and actually exceeded analyst earnings expectations.
And you hit the nail on the head. People like Buffett and everyone else talks about value and talks about it's two sides of the same coin. I mean, look, he owned Apple for darn near half his portfolio. It's something we held for almost a decade in our shareholder yield strategy. And so you can have growth be value stocks. You can have
Absolutely.
What looks like expensive companies be, in retrospect, value companies because of the growth. On average, historically speaking, it's not a great idea to buy really expensive stocks because the growth on average disappoints. And then on average, the cheap stuff is usually not as bad as people think it is. But again, it's finding out what does the market not know and what is the differentiation and where does your value add. And so you pick up some nuances in the markets. They're always changing. But like if you look at the value spreads, they're pretty high, not just in the US, but around the world. And you find some opportunities that are interesting somewhere. We tell people one of the one of the most revealing characteristics of markets today is that, not surprisingly, the value shareholder yield strategy in the United States, there's like a Grand Canyon wide spread between the valuation of the cheap stocks and high quality and the valuation of the very expensive market cap. Mm-hmm. But people say, yeah, Meb, but it doesn't, it's energy and industrials and materials and financials. It doesn't own any tech, and tech is, transforming the world with AI. And I say, yeah, but in the US, a lot of the tech stocks they're expensive, but B, a lot of them are issuing a ton of shares for stock-based compensation. And if you look at foreign, developed, and emerging markets is actually the largest sector in our strategy is tech. And that surprises people because they wait, that's a value strategy. I say, yeah. So it's not that a value quality strategy can't look for growth or can't look for tech. It's just that it's looking for it in a way that, you have reasonable valuations. And so foreign, developed, and emerging have largely been forgotten into the waste bin of history because they've done so poorly relative to the US over the past 15 years.
There's a couple of topics there. Let's real quick on shareholder yield. How do you want to define that? But I definitely want to get a foreign emerging markets and views on China as well. But How do you define shareholder yield?
The big muscle movement of shareholder yield is cash dividends plus net stock buybacks. And the net word is important because it incorporates share issuance, right? So companies that are issuing shares for various reasons. It could be mergers and acquisitions. It could be just raising money. It could also be the big one that's been ramping up over the past decade in the US has been stock-based compensation, mostly to the C-suite, right? So this is where all the politicians get all hot and bothered. But that's the two main components. Some definitions include debt pay down as a third metric, but the real big ones are this giant shift in the past 40 years away from companies paying cash dividends to more so in stock buybacks, which we call flexible or tax efficient dividends. and they
Right.
largely outpace cash dividends today.
So I think it's an excellent point you raise on that. Like share-based compensation has been increasing. Buffett's called this. I was like, why don't we recognize this as an expense? I'll give you 3 quick examples. Like literally this morning, we were looking at a Progeny, which is this hot growth stock, ticker PGNY. They do in vitro fertilization. PE ratio is 12.6 forward. Looks like a bargain. We dig in, and management is paying themselves points, mid-single digits in share-based compensation. I saw this with the Clear. We go to the airport, that security business. They've got a monopoly. There's no competition. People are price insensitive. They'll pay for convenience. Has all the characteristics of a wonderful business, and yet the share-based compensation is too high. Yelp is another one. All of these, at some point or another, actually 2 of them now have good valuations, but if management is taking the value creation in the form of share-based compensation, then the PE ratio is artificially low. And so your strategy is netting out these effects, and you've got an ETF along those lines. I think it's SYLD if memory serves.
Yeah, and the cool thing about this strategy is it inherits some characteristics of other parts of the puzzle. If you think about what you really want with the business, you want a business that is generating cash flows, like you mentioned. Like you want a great business. You want one that is oozing cash flow. Ideally, you don't want to pay crazy amounts on multiples of that cash flow, but you also want the management. So this is the G in ESG, like the governance, to be reasonable. And so, you've seen bull markets have a way of, pushing more and more power to the C-suite because they can kind of get away with more things.
Right.
And usually it's because their stock's going up. And you start to see behavior that's not just curious, but really questionable too. And so a lot of that, Brad Gerstner's done a bunch of great work here on stock-based compensation. Michael Malbison, we just had on the podcast, was talking. He's put out some good papers on it too.
Yeah.
And looking at this increase in stock-based compensation. And so if you don't use net buybacks, you'll say, hey, look, this company's doing a bunch of buybacks. It looks really interesting. And you're like, oh, wait, just kidding. They're using it just to neutralize all this share issuance. And so the challenge is many approaches don't even look at shares outstanding and the buybacks and the net issuance, which is hugely problematic because you could go like if you just did a screener and said, oh my God, I found a 4% dividend yielding stock. Like, oh my gosh, look at this. Like I'm in high yield heaven. And then you don't look at the shares outstanding. You're like, wait, they're issuing 5% a year in shares outstanding. And so I actually have a negative yield. It's like
that's a big hurdle. Then you got to add inflation to that. And now you're back to the average annual return for common stock.
So it's a data point that I think you can't ignore in 2024. And yet many or most do. I mean, if you look at the hundreds and hundreds of dividend style strategies, there's only a couple that incorporate this share issuance and buybacks. And so anyway, it's something that I think is essential here in 2020.
I agree. I'll add one other story. There's a modern variation of this now. And I saw this with the Instacart IPO. So Instacart, venture-backed company. They had a low float IPO. Now low float is a good strategy if you want something to pump, if there's a good story around it. And when the unlock was approaching, the board authorized share buybacks using the company's treasury to offset the float unlock. Essentially, it was their own plunge protection team. And I have a tweet on this, folks can take a look at online. I happen to be going through their quarterly filings, trying to get a view on this name. Ultimately, we said this is not a world-class business, but essentially the CFO, who's an ex-Goldman Sachs banker, who became this trader, and for a bit of time, it appears to have worked. And so the point is, not only is share-based compensation something you got to think about when you're looking at a stock, but buybacks are also used strategically by management, by VCs who, as you know, when they take a company public, they're going to have an enduring position for quite a while. It's hard for them to hit the sell button without impacting the price. So they're pot committed for a bit. And so there are these other gaming tactics that are shaping public markets.
Yeah. And, again, it's certainly worth being mindful about kind of the game some CEOs play. And then when you see some of it, you're like, I can't fathom being a
Right.
partner with you on how you approach, this business. You want partners, CEOs that are really owners with that mentality.
Exactly.
And I think Buffett, Buffett's been talking about this since the 80s, which is astonishing. There was someone who wrote about one of our strategies and said, buybacks don't have this long history. There's not a whole lot of academic work on this. And I responded with a book that was written in 1971 talking about share repurchases by Charlie Ellis. So I ordered it. It cost like $60 because you can't find it much. There's academic papers in the 60s about share repurchases. So yes, it's increased a lot in the last 40 years, and it's increasing a lot globally now, but it didn't mean they always weren't around. And so I think it's a topic that's
it's a sound strategy. I think there's $1 trillion in buybacks that are taking place. And, to your point, what Buffett would say is, what I love about buybacks is that I own more of the company every passing year. And it's a bid for the stock. We saw on August 7th, corporate treasurers that had buyback programs, I learned this later, were hitting the buy button on their stock. Now, not all corporate treasurers do this. Most are DCI, or I don't know what exactly, but some of them are thoughtful enough to say, hey, we're supposed to buy today because the stock is cheap. On hedge fund strategies, which hedge funds do you admire and you like, especially the less well-known ones? I agree with several of the names that you mentioned. Seth Klarman is a really impressive value investor, but names that are just less trafficked.
Oh boy, well, there's a lot. We just had probably the GOAT of investing recently pass away, Jim Simons of Renaissance Technologies. He's probably put up a track record that no one can or will ever match.
Right.
So, I have a soft spot. When most people think of hedge funds, they think of the old Alfred Winslow Jones long short, right? Tiger. Right. These are just very famous stock pickers that go long and short. Right. But really, it means all sorts of different stuff nowadays. It could be litigation finance, it could be merger arb, it could be investing in Kazakhstan. Who knows? Right. We have my arguably favorite is commodity trading advisor, trend following type of strategies, what's traditionally been called managed futures. But you've had this arc of strategies that were formerly what we would call alpha, that people charge 2 and 20 for, that have been commoditized over the past 20 years as what you would expect to be called, beta, which you can get for 0.5% or less. And so you see a lot of strategies. Vanguard has a market neutral fund. I don't know if many people know that. But
you have a long short market neutral fund. That's what, the ticker on that. I'll pull it up.
Yes, it's like I can tell you right now. It is VMNIX, and AQR has one pretty similar. Vanguard, people don't realize this, but Vanguard is one of the biggest active managers in the world, if it's not the biggest active manager. And on top of that, Vanguard has more active funds than it has passive. Last time I checked. I just got something.
Well, what's ironic about exactly your point is that Vanguard is known for the behemoth in passive investing, and you're saying they're a leader in active. By the way, the 1-year return on this fund is 16%, which is wild.
Well, what's interesting about this fund is if you pull it up from 2014 to 2020, it's absolutely
so I had a
atrocious.
drawdown.
But from 2020 to today, and then the reason I say this is because we have a fund that has a near identical equity curve, which is our value and momentum fund. But from 2020 to today, it's been great, including the drawdowns of 2022, obviously 2023. But the problem I have with market neutral is that, or even a lot of long short strategies, is if the market goes down 40, 60, 80%, you don't want to be shorting anymore at that point, right? Like stocks have already had their decline, multiples have come down, all the risk has been taken out. And so the problem is market neutral funds, if and when that happens, we wrote a really old blog post about this called The Cure for Market Neutral, which, which was basically like, at a certain inflection point, you want to start taking your shorts off the table. So the way we did it with our strategies, we said, look, we can hedge up to 100% with futures, but we want to be able to reduce that in 25% chunks. And it's based on two things, trend and valuation. So if and when the market ever goes back down to traditional normal valuations, we'll take those hedges off because it doesn't make sense to be shorting.
Right.
If the PE ratio of the broad market's 10,
exactly.
or
you
it's
want
already down by
exposure,
half.
the cheaper it gets. So you have a mean reversion component to it.
Yeah. But that having been said, it was equally as stinky from 2014 to 2020.
What was the ticker on that one?
It's VAMO, VAMO. So it looks almost identical. And AQR has the equity market neutral fund that also near identical. So for the past 4 years, hey, been great.
So these are, you mentioned value, quality, momentum, and AQR. And, my sense is that to develop these market neutral strategies, what they're doing is they're market neutral on a dollar or certainly beta basis, but they have some active factor bet, like they're a long momentum factor, value factor, and quality factor. Is that how your ETF works as well?
Yeah. And, the challenge for any of these type of strategies, and really for the entire long short space, is that when market cap does great, almost everything else, like it's headwinds, because almost all the active managers by definition are going to be smaller. They're probably going to be tilted towards some other factors like you mentioned. But, a great example is if you compare equal weight or small cap, which is kind of a decent proxy for equal weight, because equal weight you can only take back, I think, 40 years or so, as far as I've seen. But small cap you can take back a century. And you look at the performance relative to market cap weight, and you have periods where market cap steamrolls, and during those periods, passive beats all the active managers. Like it's just not even a contest. And so this is the game we play, and this is the fun part about it. But market cap, its Achilles heel is the totally crazy boom periods, because there's no tether to valuation. And so you get periods where when things go totally nutty, and this has happened a handful of times in history, where, like you mentioned, on the backside, on the downside, it can be pretty painful.
Right. That brings up another conversation I know you had with Michael Green, and this kind of has been on the podcast circuit. Bloomberg interviewed David Einhorn and said, hey, passive investing and index-based investing has killed active management and price discovery. What's your view on that?
I have a little bit of a more nuanced view that might be kind of boring, but my belief is there's a very large percentage of funds that are already closet indexing type of funds. And we wrote an article recently called, and look, I love Vanguard, Jack Bogle, national hero. We wrote and we use Vanguard funds. We wrote an article recently called "No One Gets Fired for Buying Vanguard ... but maybe they should be." And this is actually a riff on a 2018 article we wrote about Vanguard, looking at one of their funds, and this was VIG, which is, I think at the time, a $20 billion fund. And we said, look at the X-ray of the holdings of this fund. And if you look at the X-ray, you're like, oh my gosh, like this dividend strategy, A, it doesn't even have a good dividend yield, but B, all the metrics of this fund are super expensive. Well, fast forward 5 years or 6 years, whatever it was since we originally wrote this article, and we demonstrate that, a value or quality portfolio did much better. But guess what? Big went from 20 billion to 80. And at 80 billion, you can't concentrate, right? You're going to look like the market in some form. And so, and that's not terrible. I mean, again, markets done just fine. But it goes back to part of the craft of building strategies and how you go about it and what are you actually getting. Most investors, TLDR, they read the headline, the name of the fund. Almost never are they going to read the fact sheet or the prospectus and really dig into what the fund does. And so I think the challenge for a lot of these funds that are, it's 83 billion, are very large is they look like the market. And so even though some of these strategies would be considered active, on aggregate, you end up looking at the market cap anyway. But to me, like some of the challenges on market cap is, there's some of the assumptions. Like I hear the arguments, and there's always the disconnect between the diagnosis and then the prescription. So I get the diagnosis, and the question is, what do you do about it? Well, to me, going back 100 years, Ben Graham and just Warren Buffett investing 101 is like, what do you actually want? What do you want to be investing in? What's the point of this? And market cap is sort of a curious way to go about it. Like the huge innovation was because you don't do anything, you can deliver these at zero cost. And the cost was the big innovation. But now in 2024, you can deliver other strategies, quantitatively rules-based, for also cost. And so and tax efficiently. And so it's to me, there's no real reason to do market cap weight in 2024. I think almost any variant of that will outperform market cap weight by 1% or 2% per year. But the problem is, for a lot of people, and particularly financial advisors, and you have these periods, GMO wrote a piece on this, where the market cap just face ripper all the other strategies for a decade or more. And for many people, that's a career, right? 10 years, right? That's hard to withstand.
What's challenging is that, if you look at history, the most expensive stocks, the top 2 stocks at the end of any 10-year period, lag and underperform. The exception to that has been the Mag 7 name. Not even all the Mag 7 names, actually. Not Tesla wasn't around in the 2000s, but Microsoft did have a lost decade in the 2000s. But now we've entered this next cycle in the 2020s where the best performers have been Mag 7. So the test is, can they step up and do a repeat, which historically hasn't done before. By the way, I'm along several Mag 7 names. I believe in the earnings growth story, but I do think it's a name-by-name analysis. The other deficiency is that, by definition, you're owning that which is more expensive because your weighting function is based on price and value. The market's price tag.
There's some ways to, in my mind, look, I don't mind looking different, as you alluded to in the beginning. Non-consensus is totally fine for me. And so that leads to certain places like, our allocation strategies end up owning a lot of foreign stocks in emerging markets. We own other assets that people don't, particularly in the real asset space. I mean, we're halfway through this podcast and gold hasn't come up once, and it's at all-time highs, 2,500.
I'm non-consensus to the core. I think it's I'm just not terribly excited about gold where we are now. We were buying gold miners earlier this year, but
wait till it gets to 5,000, and then we'll do this again, and we'll see what happens. Anyway, I'm not
I heard gold on Bloomberg Radio. By the way, when I heard cocoa and copper on Bloomberg Radio in May, that was a top right there for those. I heard higher for longer in September, and it was a top was 30 days later. So I want to make a call saying that the gold top is within 30 days. But thoughts on specific foreign emerging markets like China, Brazil.
Let me close the loop on kind of this one comment, and then we'll get into foreign. Sure. So the listeners, I think the biggest struggle is everyone always thinks in binary terms. Like, I got to do this or this, S&P or shareholder yield.
Right.
And the problem with that is your psychology and emotional makeup gets just thrown into the blender. And so one of the easiest ways to diversify your outcomes and mental health, we call this a Trinity portfolio, but we say, look, we're going to put half of our allocation in a global buy and hold style strategy. That way we're always tethered to what's going on in the world. And the other half is going to be in this momentum and trend. And we all have value tilts and everything else, but you diversify sort of the possible outcomes and mental approach to what's going on. And it's probably not as much fun for those that like to gamble. If you're cheering for the Broncos versus the Seahawks in week 1, no one's like, I'll cheer for both. Maybe my wife does. She's kind of like that. But most people, they want something to cheer for. And so the diversifying, the quote of this is, always having to say you're sorry, right? Something's not working.
Right.
Anyway.
I like some of the names in here, by the way. Like Rev G is actually my research list right now because it's got a tremendous amount of buybacks. UHS, I think it's a good healthcare name, a bit expensive. So is Fox A.
That's the beauty of being a quant, is that half the time I don't even know what's in the portfolio. And even better is that the names that show up, I'm like, what is that company?
That's kind of,
I'm like, oh, these make,
it ties out. There's good fundamental backings. KB Homes, good home builder, folks on the lower end of the market, and a few others. Lincoln National, we own some of their competitors, and we might own a smidgen of Lincoln. Good trends. So good source of idea generation there.
Yeah.
Marathon Petroleum doing that. Go ahead, yeah.
Let's talk about something nobody wants and has been stinky. For the long arc of history, looking at foreign, meaning ex-US, for those listening that are not here, so just outside the US. The US is about 2/3 of world market cap today. Hasn't always been the biggest. In the 80s, Japan was the biggest stock market in the world. But the rest of the world, let's call it 30% in foreign developed, ex-US, and about 10% in emerging. So that is your default starting part. So point, if you're a US investor, the starting point is roughly those numbers. And almost no one has that much in foreign or emerging. It usually rounds to 0. So most people in the US put 90, if not 100% in US stocks.
Or home market bias, right?
And that's true, like you mentioned, home market bias. It's true elsewhere. So if you're Australian, you put most in Aussie stocks, Japanese, Canadian, on and on. And it's a really foolish idea on average throughout history, because you have periods where the home market does poorly. And, we don't have to look that long ago. The US did poorly relative to everything else for an entire decade prior to sort of the GFC. This has led to the broad foreign indices to being much cheaper than the US. So foreign developed, let's call it high teens, foreign emerging, sort of mid-teens, maybe low teens. But within that, the countries are always switching places, right? So nothing more so than probably China over the past 10, 20 years, where China consistently can get expensive and then gets cut in half and then goes up by double or triple, then gets cut in half again. It's currently in one of those cut in half periods where, a lot of stock markets around the world, including total returns and dividends, you go pull up a chart and look back and you're like, man, this market hasn't gone anywhere for 10, 20, 30 years. And that's hard for people. I mean, my God, that's an entire lifetime. And so you have markets like Japan that, took 30 years to get back to even, and looks more interesting today, despite all the gyrations over the past few weeks. So most of the countries around the world are reasonably priced to downright cheap. The last screen I did, I think we had Colombia, the country, not the city, down in South America, ranked as the cheapest country in the world. But on average, most things look pretty reasonable. And traditionally, U.S. versus foreign has been a coin flip on which one does better over any year.
Do you think that the cheapness of these foreign indices holds up after you control for sector exposure, right? Like Europe doesn't have any tech stocks apart from ASML. So
there's a fun. I mean, look, the 2024. It's interesting, and this is a philosophical discussion. We did an old post called "The Case for Global Investing" that dives into some of these topics, and one of them is domicile. So you could have a stock or a company listed in UK that has 0 domestic revenue, or there's a company in the US that maybe gets 100% of its revenue from Asia or something. Well, is that a US company? Is that a foreign Asian company? And then on top of that, you have some stock markets that are obviously much smaller than the US. So Denmark, for example, their like entire stock market is Ozempic, right? Novo. And then you have other places where over the years, who had this tweet? It was looking at some, people were talking about the US stock market, how it's the most concentrated it's ever been going back to the 1800s. But you look at some other smaller stock markets in like Finland. You remember Nokia? If you get any older people listen to this, had a flip phone. If you remember certain other stock markets where like only one or two stocks become the entire stock market because the stock market is just not that big. So when you're talking about countries, you got to be a little careful because some of the countries are really small. Like Czech Republic, there's like a dozen investable stocks maybe, whereas in Japan there's thousands, and certainly in the US there's thousands. So it's my belief has always been that borders and to a lesser extent sectors are becoming less and less meaningful as to what what's not a tech company today. If you look at some of the tech companies that are characterized in other sectors, you scratch your head and you're like, oh, that's kind of actually a tech company. Why is it in consumer discretionary or something else? So
I think underwriting at the asset level would be the conclusion of that. You got to take the asset for what it is. I do think the one exception to that is China. There is some country premium risk that is depressing those valuations, just given all the geopolitical risk we know. But I do think that's the right idea.
Yeah. Well, and that's the thing is like, you diversify globally, you remove some of the outcomes, and people love to get into it with me on Twitter and say, Meb, you idiot. And they'll talk about some tweet I had a year ago, 5 years ago, and they'll say, you idiot, you were wrong. International investing hasn't worked. And I say, hold on a second. International investing has worked amazing in 44 out of 45 countries around the world for the past 10 to 15 years because you invested in the US, right? You diversified into a country, one of the largest ones that did spectacular. And I guarantee you, if you're based in Greece, Brazil, Russia, China, Japan, UK, you've been ecstatic to be an international investor, right?
Right.
So it's a very myopic view to extrapolate a period that at least for the past 120 plus years has not been one that rewards investing in one single country. And we can go through examples. Now, there are some countries that seem to consistently have more problematic struggles. Russia, China are certainly two where their entire capital markets have shut down before. And you've kind of seen some some issues here in the past number of years, but it also waxes and wanes over times for certain countries. It's hard to know exactly what the future holds, which is why we diversify.
Right. No, there's definitely a benefit to the international diversification story. I mean, certainly the United States does benefit from a better demographic story. I believe better quality management on average, deeper private equity, deeper capital markets, and better earnings growth. I'm definitely on the U.S. preeminence thesis, certainly at the beginning of the year, although when, the S&P is at 5,600, then the relative value, the bargain between that international starts to shift. And now, especially with the U.S. dollar rolling over, other international markets start to look more attractive, whether it's Brazil or Mexico, and perhaps after some of the political volatility, China, and then of course, as you know, Japan's got a whole corporate reform story that's playing out.
Yeah. It's there's a lot of little fun stats. If you look at Cliff at AQR was like, hey, over the past 30 years, how much of the U.S. outperformance has been related to multiple expansion, and it's like 80%. But there is a very real growth element and earnings element over this past cycle where the U.S. has absolutely been exceptional, particularly with a lot of the big companies. And it'll be curious and fun to watch, as it always is, what the future holds. I haven't yet adopted a lot of AI into my life yet, other than for curiosity's sake. But it's clearly a lot of these technologies are super fun to watch and see what's going on.
What's your take on, has retail investing impacted? I wouldn't say transform markets. I don't think it has. I think institutions still set prices, especially for large cap securities. But, we had a GameStop, come back recently. You've got the kind of like the ARK craze, the Palantir craze, the Tesla craze, et cetera, which institutions generally don't own. Like I don't know any hedge fund that owns Palantir or Tesla for that matter. But in what way has retail investing and social media impacted markets?
Palantir CEO is an odd bird. I just was giving him a hard time on Twitter because he was talking about all these short sellers that need to
fund the stock was at like an all-time high. I thought that was strange too.
Need to fund their cocaine habit or something. And I was like, have you met any short sellers? Like, first of all, there's none that are left. They're mostly extinct. And second of all, they're like the super nerdy accountants. I was like, you hang in different circles, I think, than reality. Anyway, it's tough for me because it's exciting to see during the whole COVID meme stock era. The positive is younger investors are getting interested in markets, and that's great. The downside is they were kind of being like led lambs to slaughter straight into the casino by people like Robinhood, who I think are absolutely morally bankrupt, and history will not judge them kindly, and others of that sort
because
of
the gamified nature of investing and kind of
gamified, but also at every possible turn. If Vanguard is like the shining light here, with like you go down the road, there's a fork in the road. It's like left is like the fiduciary way to go, and right is thorns and brambles, and how can we extract as much value of this customer as possible? At every turn, Robinhood took a right, and I just think they're so absolutely full of it. And by the way, as evidence, when we were talking earlier, talking about the C-suite doing shady things. If you remember when they went public, they magically said, "Oh, hold on a second. The founders we're not going to wait the 6-month lockup. Like, we're going to go ahead and sell our shares early." You're like, wait, what? What? And then the stock went down like 80% or something, deservedly. Anyway. So
investing is hard. It takes skill, and there's really no break on Robinhood.
There's
24/7 trading.
There's lessons to be learned. And I have a 7-year-old, which, if you were watching the beginning of this, is the reason I was so sweaty. Was out on my bike this morning with him, but we wrote a book during the pandemic, which I haven't finished, but was really frustrated by the concept of like, how do you educate people in the right way? What book should they read? How should they go about this, rather than here's an app with confetti and let's go trade some options in your IRA,
Right.
And so, there's some ideas and concepts we're really working on. Chris Davis was on the podcast, Old School Value Manager, and we talked about the idea of developing a book curriculum for kids, where you're like, all right, here's going to be the 5 or 10 things you're going to read in order. When you got to do like a little book report, almost like just like a little feedback after the first one. And he was talking about with his kids, where like maybe you give them $50 or something after every book they read, you put into an account, you learn the lessons, you do it together. That's different than the way, first of all, they don't teach it in high school, but in the 10%, 15% of schools that do teach it, they do like, let's do the stock investing game. Who can pick the best performing stock over the next month? It's like, wait, what? Like, how is that possibly teaching anything? Anyway, there's the big news this past week was academic paper showing, the big interest of particularly the younger crowd of gambling. And we've seen this with the options. We've seen this with short dated multi-leverage funds, but with sports betting, and how much sports betting has taken off, but how much that reduces investment.
I scanned the abstract of that. That's not good for public wealth creation longer run.
It's good for the casinos. It's good for somebody, right? It's just not good for the end user investor. Now,
betting is zero sum. investing is positive sum.
Yeah. Yeah. So, it's a headwind trying to teach this, but I think it's doable, and I think it's worth doing.
Right on. What are some of the lessons you've learned or rules of thumb that you have that you think might be helpful for others to learn, from your experience and investment journey?
Despite all the nuanced and very detailed esoteric ideas we talk about today and elsewhere that seems very jargony, by far, we have an old article called something like the investment pyramid, where we were doing a riff on the food pyramid of our youth and how it's changed over time. And we said, if you look at the investing pyramid, like by far, number one, your base is how much you save and invest in the first place. So get started early, start saving, start putting it to work, because the magic of compounding accelerates over time, and you look at like the amount of Buffett's wealth that's been created, the vast majority of it has been when he's, pretty old, right? But my favorite investing stat is Berkshire can decline by 99% and still be outperforming the S&P since inception. Like, that sounds so false.
Incredible.
But it's true. Listeners, go take a look. Anyway, so the first thing is save and invest in the first place, get started. Second is, this is a weird take, but I don't think it matters that much what you invest in, as long as you start getting invested in cash flowing type of assets, stocks, global stocks, REITs, over time, right? So in doing it, starting, mentally low cost, and cost doesn't just mean expense ratio. It means commissions, it means trading, it means taxes, all that stuff. So you get that base into place and have the mindset of, all right, if I compound at 10% in 25 years, I 10x my money. In 50 years, I 100x my money. And so if you're a 20-year-old listening to this and you're like, oh my God, that $1,000, that's $100,000 in retirement. $10,000 is $1 million. And then the problem is you start to equate expenses and things you're going to spend money on with, what is this worth to me in 50 years? So, hey, this vacation, we're going to Hawaii, 10 grand. We're like, well, that's worth $1 million.
Part of it is, there's call it a get rich quick dynamic where people want to chase like a growth stock, let's say, that's fully priced consensus and prone for disappointment, right? Maybe that was Snowflake not too long ago. By the way, I fact checked your Berkshire Hathaway stat with GPT and it came in green light. You're good. So for the folks listening, it is a legitimate. If Berkshire lost 99% of its value, it would still be in the S&P 500 since inception. But right,
I think it's like 99.8, but I didn't want to round up too much. 99 already sounds too fantastic. It sounds like a shit post that's not true. There was a great article that was big in the academic community, and we had the author on the podcast, Hank Bessenbinder. He's like, do stocks outperform T-bills? But then we asked him some questions, and I was like trying to tease out of him. I was like, what's the best performing stock of all time? Meaning the last 100 years since we really had data. And the answer was Altria, so a tobacco company. But the funny thing was number 2 and 3, most people probably wouldn't have picked or heard of them. It was Vulcan Materials and Kansas City Southern, right? A railroad. And they didn't do some crazy number. Like it was like 14 to 16%. They just did it for 100 years. And so the cumulative percentage for Altria was, I can't even do the math on this. It was 265,528,901%, right? So you put in, I forget what it was, like $1,000, you end up in multi-billions, right? So it wasn't that they were compounding at 50% a year, which is everyone, if you follow Instagram, these ads are like this, invest in this self-storage facility.
Right.
You're going to do 50% a year. I was like, you don't need to do 50% a year. You just need to do like 10.
Yeah.
You just need to do it for a while.
In 7 years. Yes.
And most people, that's what gets them tripped up.
Right. No, I agree. It's so easy to kind of hang yourself through a noose. Here's the Old Dominion freight line. It's a boring stock that's done extraordinarily well. Another one.
Beautiful chart.
Look at that beautiful chart. Right now, there's bear markets and corrections in there, but it's a company that generates cash flow, and it's not going to get disrupted by AI. I don't know enough about that. I'm just supporting the point. Here's another one. This bank I actually do own, FCNCA. This is a publicly traded bank that's been kind of owned by its family for a few generations, and it's beaten the S&P 500 in successive decades. They picked up Silicon Valley Bank.
Oh, yeah.
Great deal from the FDIC, and they specialize in bank takeovers. So, I think you're correct. Look, there's still a role for commodities, as you pointed out, CTAs and other kinds of commodities, digital assets, I believe too. But things that generate free cash flow and can compound and reinvest and grow and build a great business with a moat and a brand, that's investing 101. And I think people just get offsides by trying to pull the forward too quickly, and they speculate, and you wind up getting a situation like ARK, which had tremendous inflows, and the average share price I think is still like in the 2018 levels.
There's Bogle had, one of his older books had a stat that looked at the best performing mutual funds per decade and then the ensuing decade. And it's not surprising. And it's a very seductive and easy thing for all of us to do, which is to anoint a strategy or manager or asset class. Right now, it's US stocks, it's mega caps, maybe, with the crown, and say, oh, this is going to last forever and into infinity. And not surprisingly, Bogle found, and Morningstar's done a lot of research on this, that, the ones that did the best, not surprisingly, the next decade didn't do so hot, they underperformed. So
I agree. Well, that's right. They become fully priced in consensus. Microsoft, world-class business, achieved a significant valuation, .com era. Cisco, same thing. Cisco crashed, Microsoft crashed, then went nowhere. I think there are areas in the market where we see that now. Any other thoughts and learnings? You have this interesting trend strategy too.
Well, you just open up a can of worms, like, as we're, cruising through this podcast. Trend is a strategy that I think is a little more challenging for people because it's often discussed in the same breath as, quote, market timing, like the biggest sin of the world. So we just spent all this time talking about buy and hold and investing for the long term. And all of a sudden you're like, wait, you're going to tell me tactical or market timing is possible. Not only that, but it's a good idea. Well, that just like fries everyone's brains. But trend is something that's been around for 100 years. People were talking about Dow theory back in the time of Charles Dow, started the Wall Street Journal 100 years ago. And trend, as I think about it, there's a million ways to get into it. But in the modern parlance is like looking at as many possible investments to trade, which is already way more than most people would consider. You mentioned cocoa, gold, but also Swiss franc or the euro dollar, or even things like carbon credits, and trying to be invested in these as they're going up and out or short when they're down. And the unique feature of this strategy is that it often does well when other things are doing poorly in the traditional.
They did well in 2022, the CTA.
2022, 2008, 2009, the periods of stress, because usually the macro factors, something is going awry. And the problem is that it looks different, aka underperforms in periods often where other traditional assets are doing just fine. And so from like 2010 to, 2018, 19, probably did poorly. But on average, personally, to a traditional portfolio that's properly designed, so US stocks, bonds, real assets, I can't think of anything that does a better job to diversify a traditional portfolio than that. Because the problem with the traditional portfolio is it's very highly correlated to what's going on in the real world and your own personal human capital, as well as the economy. So it all hits the fan at the same point, which is not what you want.
I agree. We have an allocation to look. I think most hedge funds are highly overrated, but some of them are worth their salt. Very few of them are worth their salt, especially to your point before and after fees. You look at alpha cloning, and the fact that most of these tiger cubs just own Mag 7 names, which you can replicate. I think there's an ETF called MAGS, MAGS. If you want to do
great sticker.
You can own that. But you're right. Like these CTAs, they perform when markets trend, and when markets trend down, in a bear market, they can do really well. Obviously, there's whipsaw risk when markets are just kind of churning. But if you've got an allocation that has a certain role in the portfolio, then I think can add value when other assets are tanking. But I think if you zoom out, like the broader idea behind that is having a cross asset class approach, right? The only thing you invest is in equities or bonds, and generally as you're negatively correlated, then that's how you see the world. But like in 2000, when .com was crashing, real estate assets were cheap. That was a time to go buy real estate. Then real estate became expensive in 06, 07, and equities were also expensive. Bonds arguably were cheap then. So that would have been the time to do a rotation. So I think if you zoom out and look across asset classes, I do think that you can, it's not even so much about market timing. It's more around saying, where do I get the most length for my marginal dollar? Where is capital rewarded best? If you look at it that lens, the market timing topic changes entirely.
Yeah. We looked at we did an old paper on, what assets really help when the market was going down. And the challenge is everyone assumes bonds will help, and on average they do, but not always. And particularly in the first half of the 20th century, they really didn't in most of the cases. Gold is, you never know. It might not. So trying to add as many things into the bucket as possible, but even then having the humility and knowledge that like you're not going to escape a 25 or 30% drawdown at some point in your portfolio. And then more likely, if your equities only, like kick that up to well over half, right? So, but Charlie, the late Munger, was always like, look, if you can't handle your portfolio getting cut in half every decade or two, like you shouldn't be in equities. Like it just, that's part of the entrance fee.
It's about psychology, and you need investors that are signing up for the psychology. One of the best things about Buffett and Munger is they've got a tribe and a community around them that believes in them come hell or high water. So they're not or they're less prone to make a decision to sell the bottom.
And they've also made a lot of people a lot of money over a long time. So
they earn that trust.
Money tends to be a little more forgiving.
We see it in our own clientele. When I have a client calls in and they're afraid or they want to get in, like everyone's pro-cyclical. Not everyone. A lot of people are, right? People want to invest at tops, right? Yeah. And they want to buy bonds at bottoms, and they should be doing the exact opposite. Be right. The whole be greedy when fearful when greedy. Well, Meb, this was absolutely terrific. Thank you so much. How can folks learn more about Cambria and follow you?
Yeah, not a lot of Mebs running around the world. So usually you can find me on the podcast. Mebfaber.com is the blog, and Twitter. We even have YouTube and TikTok, I'm told, at this point, for the youngins out there. But the day job is Cambria ETF company. We got 16 funds now, a few more coming with some interesting ideas, and that's CambriaFunds.com.
Terrific. And we'll have this rebroadcast, post-produced. It'll be on YouTube, Spotify, TikTok, Instagram. We'll have short reels. If you follow @Lumina Wealth, that handle on Twitter, we'll also have kind of highlights reel there too. So that'll be released in the next 24 to 48 hours. Thank you, Matt. We'll have to do it again. Appreciate it.
Sweet. It was fun.
Take care, everyone.